Hello, everybody.
Hello.
Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are going to have ourselves a little bit of a pivot away from U.S. markets today, but only briefly, because, of course, the consternation has now struck Europe. Needless to say, quite a bit of ugly price action around markets today as Credit Suisse enters the barrel here and comes into the crosshairs of the markets after the collapse, of course, of SVB and the adjacent drop in and government takeover of Signature Bank. And not a moment too soon, we have an ECB monetary policy announcement. So this becomes, in a way, the kind of trial run for what the Fed is going to face next week. And of course, we know that is likely to be formative for all financial markets, all assets, everywhere. So this should be really interesting because the ECB will provide a kind of trial run, a kind of look at what happens when a major central bank attempting to fight inflation wades into this minefield that we've now found ourselves in the banking sector. So let's begin with a conversation about what is it that the ECB is trying to do, why they're trying to do it, and how their best laid strategy here is being challenged by events and what that might mean going forward. So let's consider first what the ECB is looking at on the inflation front. And here, this is very much the story that we're seeing in the U.S. replayed again, though, of course, the inflation rates here are much higher. The Fed went after fighting inflation sooner and harder than did the ECB. We, of course, had the end of asset purchases and the start of quantitative tightening, much more quickly engaged in the U.S. And so the inflation rates in Europe still quite a bit higher than they are in the U.S. You can see the latest readings here, the Eurozone and the German number, Germany, the largest economy in the Eurozone, and so something of a benchmark for this whole thing. So you can see that as with the U.S., market expectations for inflation, and in this case, the liquid break-even is the 10-year, so that's what we're looking at. It's not quite within the window of policy as the 2-year break-even is for the U.S., but it nevertheless tells you what the trajectory is. And when you look at what that trajectory is, it is worryingly not coming down. You can see the front running for these expectations ahead of CPI appears to be about 6 months, so a little bit longer, in part because of the longer maturity of the break-even. But nevertheless, what you're looking at is inflation expectations not falling in an aggressive way over the past several months, as the ECB, before any of this banking stress, was ramping up to tighten. And so, ostensibly, what this is telling you is if the goal, as with the Fed, is to get to 2% inflation, ultimately, the ECB is still way offsides. It still needs to do quite a lot more. This is especially the case because you can see in the most recent yellow bars here that you see on the chart, inflation is actually setting higher highs, or inflation expectations are. And so you would expect that there's something of a market signal here. The bond market is essentially telling the ECB, you've not done enough. This is trending the wrong way. You need to do more. And so with that in mind, you have a situation where the ECB needs to go, according to the bond market signal here, and needs to keep raising rates. Part of this, as with the U.S., is the recovery in economic growth. So you can see the overall economy, the composite PMI here, now above that telltale 50 line, which essentially means that we have growth that's positive across services and manufacturing taken together, even as manufacturing itself remains in contraction territory. Just a quick reminder, these PMI numbers work on a logic centered around the 50 line. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what we're looking at with a number at 48 for manufacturing is a manufacturing sector that's shrinking, but at a slower rate than in recent months, so certainly than in the bottom there in October. When you look at the conditions overall and the conditions in services, of course, in the Eurozone, as with most developed economies, by far the largest sector of the economy, overwhelmingly more important. You have a pickup in growth, and that gives you an average sort of composite number, which subsumes into it both services and manufacturing, that's well above 50 and basically tracking the services component because that's so much of a greater share in this average. It's so much of a dominant portion of the economy as relative to manufacturing, even though you have quite a bit of a strong manufacturing hub in Germany. So with that in mind, a pickup in growth, which is, of course, inflationary. If you look at the way that Euro area economic data has performed relative to expectations, you can see it's cooled a little bit in the past maybe 2 months or so, but nevertheless remains above the zero line. And so the tendency still for Euro area economic data is to surprise higher relative to baseline expectations, albeit by a diminishing margin. And so you still have a story ultimately of an economy that appears to be buoyant enough to keep feeding inflation. And then, of course, the ECB's job is right there in front of it. The problem is this. In the orange, you have the OFR, Financial Stress Index. That's from the U.S. Office of Financial Research, which is a government entity. And what you see here, needless to say, over the course of this month, is a significant pickup in financial stress, largely following on from what's been going on with SVB, Signature, and some of these other jitters. Here's the knock-on effect on Europe. So the dark line there is the Eurozone Financial Conditions Index, FCI. And what you see is as stress in the banking sector builds, you also have a tightening of financial conditions. So in other words, people with money become reluctant to lend that money because whoever is on the other side, the counterparty, in a situation where there's all this consternation, might well fail. And so people are really holding on to their cash. They're not lending it out because they may need to paper over losses. They don't want to be one of these banks that's struggling for capital and struggling to raise cash. And so cash is being held back. It's not being lent out. And so financial conditions are tightening. You can see that in the Eurozone, you were still looking at fairly loose financial conditions before the start of last year. And then as the Fed begins to tighten, and the ECB ultimately follows, you see that index slip below zero and begin to tighten. Not surprisingly, it gets a little bit of relief in the fourth quarter of last year, as did risky assets broadly. And as the ECB starts to signal, maybe they're getting ready to the end of the tightening cycle to some extent, or at least approaching it. And of course, now we're right back to much tighter settings. So in some ways, the market the market turmoil is doing some of the tightening for the ECB and is starting to lock up the system a little bit more. The most worrying, arguably, part of this is the red line. That's the spread between Italian and German 10-year yields. This is sovereign risk. This is the kind of thing that brings back echoes of the Eurozone debt crisis of the 2010, 2011, 2012 sort of period. Italy is very debt-laden as an economy, largely because its approach to dealing with the various issues during the 08-09 crisis was basically to assume their banking sector's liabilities, to basically say, we're going to backstop all of the Italian banks. Then those Italian banks never really cleaned that up. They're essentially still sitting there with piles and piles of bad debt, and the expectation that the government will ultimately backstop it, and the government's expectation that the euro area will ultimately backstop it, and the euro area's expectation that Germany will ultimately backstop that. The problem is that when you start to raise rates on this giant pile of bad debt, you have shakiness and the possibility that that debt will not, in fact, be as benign as it is if rates are zero, right? If rates are zero, that debt is very easy to refinance, to carry forward. It becomes cheaper to sort of manage it over a longer period of time. But if rates are rising, then rolling over that debt becomes a very expensive sort of thing because you're rolling over to much higher rates. And then some of these banks that are larger, in particular in Italy, with all this debt, start to have issues. Those issues, in so much as the Italian government is on the hook for them, start to question the financial viability of Italy itself. And so as people look then at the spread in borrowing costs between Italy and Germany, they begin to say, well, we need to be charging Italy more than Germany because it's clearly more of a default risk than Germany. Germany doesn't have this tie-up to a giant pile of bad debt sitting in German banks. Italy does. So when you start to see the widening of the Italy-Germany spread, what you're seeing is basically the risk premium that's being attached to lending to Italy start to widen. You're seeing people start to demand more interest from Italy, which of course just compounds the issue, because Italy starts to become something that appears more dangerous than Germany does. You can see that with the pullback in the OFR financial stress index, the uptick in the Eurozone financial conditions index, you saw a bit of relief on that. So as the Fed initially started tightening, sovereign spreads widened. The idea that maybe the ECB would need to go big, and of course they've telegraphed as much since, that this was going to further increase sovereign risk and once again raise these possibilities that a country in the Eurozone might be unable to pay its debts. That, of course, would be catastrophic if it were Italy, the third largest economy in the Eurozone, one of the original 6 members, and a giant debt market, whereby if it were to fail, lots of people that own these assets would end up with big holes on their balance sheet and then have to sell other things to cover those holes. So there could be a real cascading of sell-off here on a really epic scale if Italy were to really move to the logical conclusion of what this kind of spread widening would mean. And that, of course, is a very long ways away. It's by no means imminent. As you start to have that kind of stress, you get that sovereign spread widening, as it seems in the fourth quarter of last year that central banks are backing away, that they're starting to maybe think about winding this thing down. You get that stress easing, and of course now it's right back again, and for all the wrong reasons. So you have in this not only more stress, not only more sovereign risk, but also monetary tightening, which of course compounds the other two issues. And so in response, what you have is a shift inward on at least the first 1 year span of the yield curve. So you can see a week ago, the yield curve was a bit more steep, certainly from the policy rate now out 1 year. You can see relative to where the last ECB meeting was, it wasn't quite as steep. It has come in relative to that as well. So what you're looking at is still a peak of about 4 on the ECB deposit rate. That's their target rate here. But the path there is looking like it's going to be quite a bit more shallow in the near term. This is what the landscape looks like now. Keep in mind that the ECB went so far as to pre-announce a 50 basis point hike at this meeting, and now the market doesn't think it's going to happen. They announced last go-round at the beginning of February, here's 50 basis points. We're almost certainly, they said, going to do another 50 basis points in March. Well, looking at the implied expectations now, they're going to barely get away with 25. So if you look at the implied rate delta column, you got 28, almost 29 basis points in there. So that's only a 14%, 15% chance, if you look at the percent hike / cut column, that you're going to get that 50 basis point move. That's the probability of a 25 basis point rise. So having that at 114, 115 means you have 100% chance of a 25 basis point rise, and then a 14, 15% chance of a 50 basis point rise. You can see that you get to those 50 basis points come June, but you never quite make it to 75. So you never quite get another set of hikes. It looks like the next 50 gets a little bit more spread out in the market's expectation, and you ultimately are left with rates at about 3 going into the rest of this year. So you get from where you are currently, which is 250, you get to 3 within about a year, or within the rest of this year, I should say, and then you're idling there. And maybe then, if you look at the curve now, maybe then you start to get more of a move higher. But looking at current expectations, where you were supposed to be ending up by the end of this meeting over the next 24 hours, looks like where we're going to get to in July, and then stay there for essentially the remainder of this calendar year at least. This is what that looks like. So you see in the orange and the red, the expectation for the meeting in July. So you can see there, we still have basically that move toward 50 basis points by then. And you have, by the end of this year, essentially the same setting. You never make it to even 3.25. And you can see that that's a far cry from where you were days ago. But of course, with the surge in market stress that you see captured there in the financial stress index, a significant rejiggering of expectations has occurred. Now, what is the upshot of this for broader markets and, of course, the euro, and then from there, everything else? Let's look at the euro first. It appears as though we're forming something of a top. It's not confirmed yet, but it does look like, from a technical perspective, that you're shaping up to form a bearish head and shoulders setup here. So there's the shoulder head, and then maybe that's the right shoulder being carved out now. We won't know until we get confirmation on a breakdown. And the most conservative way of looking at this neckline here seems to be to put it at around 105.30. So if that's the case, and considering the head there is just around 110, the way that you would extrapolate the downside objective in this kind of environment is you would say, okay, if you were to get a close under 105, give or take, 105.29 specifically, you would extrapolate the distance from the tip of the head down through the neckline and essentially measure out equidistant the decline from there moving lower. And looking at that in relative terms, the high on the head there, as I say, is right around 110. And so with that in mind, specifically 110.60 is that high. So you figure you have about 530 pips then lower implied in that decline that you see here, which from 105.29 takes us to test below the parity level with the US dollar, takes us back under a level where €1 buys you $1 and gets to a place where you need more than €1 to buy you $1. That would be clearly a very substantial move, not confirmed yet. But this really illustrates how this market is setting up. So if we get an ECB that comes out today and, for lack of a better term, blinks and says, look, we can't be raising rates by 50 basis points when the market is clearly experiencing this level of consternation. And by the way, the consternation, as we just saw, is working to tighten financial conditions. So we can actually afford to hang back a little bit. Maybe we'll do the 25 to maintain credibility, but we're probably not going to give guidance about just how aggressive we're going to be going forward. That's a situation in which the euro probably heads lower because it suggests that a major central bank is starting to become afraid of its own shadow. And first of all, the implications would be the yield prospects for the euro have significantly darkened. Second of all, it would mean that the Fed may well follow suit. Now, the Fed doesn't have as hard of a job, but it would suggest that a major central bank is worried enough to change baseline monetary policy, to back away from the inflation fight, somewhat, not fully, but somewhat, to at least ease off a little, which, given inflation at 8%, just means that the euro remains vulnerable, because then there is not a pushback against that inflation debasing the currency. All the more reason for it to go down. On the other hand, if the ECB doesn't do that, if the ECB says, look, we're still committed to the inflation fight. Maybe we only do 25 here, but our focus is singular. We'll see how it goes. We'll see if the ECB is able to sell that message. But of course, if the message is we're going to press on with tightening, the markets are going to ask, okay, well, how many more banks are you going to topple along the way? Where else are there issues then if you're going to keep applying stress to this system? Perhaps it is best to cash out and back away. And of course, the most liquid form of cash is the US dollar, which from the Fed's perspective is actually a welcome tightening. So it could be that the ECB feels compelled to defend its inflation-fighting credentials and comes out and says, look, we're going to keep going. This is something that's going to get dealt with by the SVB. After all, Credit Suisse is not something that is within the purview of the ECB. It's within the purview of the Swiss National Bank, ostensibly. They're going to step in and recapitalize this bank if they have to. The Eurozone banking sector is going to be okay through all this. we're going to keep going. The euro might catch a bit of support there, but ultimately the conversation is going to be, okay, well, what's all this extra tightening going to do to create more credit stress? Let's de-risk, let's go to cash, which is something that benefits the US dollar. Whereas if the ECB does blink, well, that benefits the US dollar directly, especially against the euro in particular. Which brings us then to what happens with the Fed. If the Fed is going to ease off a bit from the inflation fight, dealing with similar issues, that would suggest something is indeed very wrong and could be supported for the greenback on haven grounds. But if the ECB is soft and the Fed doesn't follow suit, well, then you have the makings of a really explosive euro collapse. Because then the dollar would look better for both anti-risk reasons and relative yield reasons. Now, of course, a stronger US dollar then has knock-on effects on stocks. It's not good news there. Knock-on effect on financial stability across the emerging world, where there's a lot of dollar-denominated debt that would become more expensive to pay back. The cost of dollar liquidity would tighten for everyone, and so create a further risk of instability and crisis, which would only feed the dollar more, and a vicious cycle of risk aversion ensues. So how the ECB ultimately frames this will be very interesting. The outcome that's probably the most supportive for global markets, strangely, is an ECB that remains confident, that says there's no problem here. Swiss regulators will handle this. Much like the Fed said about SVB, this is episodic, not systemic. And then the question will become whether the markets buy that. And whether they do will probably depend on what the Fed has to say about it next week. But if the ECB is going to get cold feet, which is much more likely than the Fed getting cold feet because of this extra sovereign stress dimension, well, then the consequences for U.S. stocks, the dollar, gold, crypto, and everything else tied into this perception that something is really and truly wrong enough that central banks, including the Fed, might need to slow their inflation fighting role, well, then you have a much bigger issue here in the very immediate term. And so watching how this ECB reaction is going to go and the euro response to it should be extraordinarily important over the next 24 hours, in so much as it might well set the stage for much of everything that follows. And that is macro money for today. We'll wrap it up on that happy note there. Thank you very much for joining me. As ever, we are here on Macro Money 4 days a week, Monday through Thursday. I'm also on with Tom and Tony on Sunday for First Call, and on Overtime 4 days a week before this show with our friend Chris Vecchio, head of Futures and Forex, and then on with him again for Friday, Futures Power Hour. Outside of those shows, you can follow me on Twitter for all of my various musings on markets. That's at Ilya Spivak. Good luck out there. Happy trading. Speak to you guys tomorrow. Take care.